Guys, nobody tells you this very specific thing about the 2026 stock market. The biggest risk right now isn't a crash. It isn't AI. It isn't even the Fed. It's actually you. It's me. It's people like us, because when tech stocks fall 10%, 20%, 30% in a matter of weeks or months, most investors don't lose money because the business has failed. Microsoft, Meta, Amazon, these companies are all 10 or 20% off of their highs. Did the businesses actually get that much worse? No. In fact, they got better. So that means most investors lose money because they panic. And over the next few years, volatility is absolutely going to test people in ways that they're not prepared for. Why? Because we haven't really had a long-term bear market in almost 20 years. So let's start with what's happening this very second. Over the past few weeks, we've seen heavy selling in major tech names. AI darlings that could only go up are suddenly pulling back. High multiple growth stocks are getting repriced, and mega caps that felt invincible are wobbling. Listen, just a few short months ago, when a company announced a deal with OpenAI, it shot up. Now the same news comes with crashing down. Another example, in 2025, AI capital expenditures were the two words that guaranteed a successful earnings report. Now people are questioning if the spending will actually pay off. And what happens every single time stocks fall? Headlines shift instantly because news follows the stock price. It goes from new bull market just getting started to, is this the beginning of a bigger crash? Guys, the market doesn't move in straight lines. You have to understand that. It surges, it pulls back, it goes up, it overreacts on both highs and lows. It recalibrates very frequently. That isn't a prediction. That's just the way cycles work. You know, I like to say, guys, there are 3 guarantees in life: death, taxes, and cycles. Guys, this is the S&P 500 going back to 1950. There are ups and downs here. And the further back you go, these things don't look like big falls, but they actually are. But over time, look what happens. Now, do I think we're overvalued now? Absolutely. But even if the market fell in half today, you're still looking at this, which is still a consistent growth. As the US economy grows, so will the stock market. Now, here's what most people don't understand. Volatility is not a flaw in the market. It is a feature. When expectations get too high, prices will stretch. When fear takes over, prices compress. And in between those two emotional extremes is where disciplined investors like Warren Buffett, like you will be, like myself, will quietly build wealth. If you don't understand what's happening, and more importantly, if you don't understand your own personal psychological makeup, 2026 is going to feel very uncomfortable in all likelihood. And uncomfortable investors make expensive decisions. Guys, one of the most important things I did for myself was understand where I stood emotionally and where I stood with my own financial goals. Once you're able to understand that, you're going to make much clearer decisions. You're not going to have as much FOMO. And let me say something that's going to sound controversial. Volatility is profitable, but not for the inexperienced investor, not for ones without a strong process, and not for ones that don't have the stomach. The good news is, the more experience you get, the better process you get, the better your stomach will feel. It's very profitable for trading desks, that volatility. It's very profitable for algorithms. It is especially profitable for media companies that monetize your attention. Guys, even look at our click right here. We made a video with a title to get your attention, to then teach the real story behind everything. Every sharp red day creates clicks. Every breaking news banner keeps you watching. Emotional investors see those big red days, and here's what they do. They sell during drawdowns. They wait way too long to get back in. They buy after the market has already recovered significantly again, and they just keep repeating the cycle over and over again. And that behavior gap right there, that's the difference between market returns and average investor returns, which is enormous, especially over decades. Study after study shows that the average investor dramatically underperforms the market, not because they pick bad companies, because they panic during volatility, hesitate during opportunity, buy at the wrong time and sell at the wrong time because of a lack of understanding and a lack of process. So let me reset your expectations right now, because the last 10 or 15 years trained people to believe that dips are shallow, recoveries are fast, and buying whatever is out there will work. That period was not normal. It was fueled by historically low interest rates, massive liquidity injections, and explosive multiple expansion. What does that mean? Guys, the government came in, put a ton of money into the economy, and it buoyed up this economy and therefore stock markets. Back 15 years ago, PE ratios were low. Price to free cash flows were low. Now they're much higher. So not only did profit get higher, but the multiple that people were willing to pay jumped up. When money's cheap, mistakes can be forgiven a lot easier. When money costs something, like 4, 5, 6%, mistakes get exposed. We are no longer in the free money era, and that means volatility won't just appear, it'll probably persist. Guys, at some point, if you can make 4 or 5% holding cash in treasuries and you see the market going crazy, what would the average person do? Guys, you're going to see 5% drops in a week, 10% corrections that feel like crashes, individual tech stocks falling well more than 20 or 30% in several months, even sudden rebounds that confuse everyone. Hell, we've already seen a lot of these so far. And here's the important part. A real process is not built on prediction. Guys, market overreacts in both directions. You can't possibly guess what will happen. Just look at the last week. Go back and look at the earnings releases of the last week. Companies double beat, fall like crazy. Companies miss by both, go up. It's absolutely random. They overshoot optimism, they overshoot fear. And if you understand that, volatility stops feeling like manipulation and starts feeling like opportunity. But only if you're prepared. That's why the next section is what people need to hear the most. You cannot wait for the perfect moment. You will never get it right. You cannot sit in cash for 5 years waiting for CNBC to tell you it's safe again. And you definitely cannot jump in and out every single time the market feels scary. You're going to get burned. Because here's what history shows over and over again. The biggest up days happen during the worst volatility. Miss just a handful of the best days over a decade, your returns get cut in half. Why is that? Because fear clusters up. The worst headlines often appear right near the bottoms. The strongest rebounds often begin when sentiment is still terrible and possibly at its worst. That's why we always say you need to be investing at all times. Now, let me clarify something very important. Being invested at all times does not mean throwing all your money into hype, chasing the hottest tech names, or ignoring valuation. It means you have a disciplined plan. For most people, that means dollar cost averaging into low cost ETFs every month. No drama, no guessing. Guys, I have 1,000 apartments upstairs that I own. I own several businesses. I dollar cost average every single month. You are buying the market's long-term productivity. You're betting that the US economy will be bigger and better decades from now. Sometimes you're going to overpay. Sometimes you're going to underpay. Over time, you will pay the average. And when the markets fall, great investors don't freeze. They lean in. That's where portfolios are built. That's why members of our software, those who are part of our community, love to see the red. In our community, when we have big red days, people are cheering. Guys, I love telling this story. And the sad part is my friends who said this don't even remember. Back in 2006 or 7, I had 2 friends of mine who just got married. The market was good in 2006. It was still going up. And they said, hey, we want to sit down and talk to you about saving for retirement. So we sat down and the numbers looked great. But I asked them a question. I said, guys, if the market fell 50% tomorrow, what would you do? The wife looked at her husband, looked at me and said, well, we buy more, right? I said, exactly. You get it. And I loved it. Fast forward. Middle of the financial crisis. Stocks are falling like crazy. I get a frantic email from the wife. Paul, blah, 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 the world's falling apart. What are you doing? I said, if you remember, we talked about this and we said we'd buy more and you said that. And she said, yeah, but the financial crisis, the world's shutting down, etc. And I remember thinking to myself, well, what else would cause the market to fall 50% suddenly? She wrote me an email and said, we're selling everything and we're going to wait until things feel calmer. And guess what? For the next couple of months, they looked smart because the market went down further. But when did they buy back in? After stocks were up 20 or 30% higher from the point they sold. She actually said, I'm worried about our money going to zero. Guys, same people, same stated plan, different emotions. When I hear people now say, I'd buy more if stocks fell 50%. If NVIDIA fell 50%, I'd buy more. I'm like, really? Because Microsoft in 2000 was a stock you couldn't miss. And in 2012, when it was selling for 8 times earnings, a tech CEO was telling me that it was a dead company, even though revenue and profit were going up 7 to 12% per year. That's the difference, guys. When markets fall, in theory, everyone's brave. When markets fall in reality, almost no one is. That's why we're here teaching on this channel, because I know there are a lot of people out there who have the ability to think this way. And here's what most people miss. The biggest long-term gains are born inside panic. When great companies get sold off massively, when ETFs get dumped because people need money, they need liquidity, when algorithms push prices below rational value, that's when great portfolios are built. And these portfolios and these great ones are going to be built not because you timed the bottom, but because you were buying when expected returns improved dramatically. Think about someone who bought the broad market, the indexes, in March of 2009, or April of 2020, or November of 2022, when sentiment was so low. They didn't need to be a genius. They just needed to have the stomach to say, it'll get better. And this is exactly why dollar cost averaging matters so much. You're always investing no matter what the price is. And when markets sell below value, that's when prices below value, you increase your exposure, not emotionally, but intentionally. Guys, I always say this. If markets are going to zero, you should invest anyhow because your money's going to be worth nothing. But if markets are falling, then they're probably all likelihood going to rebound at some point, so you might as well be buying. That's why I don't get the whole idea of, well, the markets go to zero, I don't want to invest. Guys, the market goes to zero, whoever has the most guns and land is going to win. That's it. So how do we actually find opportunity, whether the market is up or down? Because we don't just buy randomly. We have a process, and that's what I want to walk you through next. So how do we find those opportunities in a market like this? Well, we use structure, and there are different ways I want to explain. First, one place I like to start is 52-week lows. Now, I want you to hear very carefully. A stock hitting a 52-week low does not mean that it's cheap. It means it's cheaper. It means it's been punished, and punishment should create questions. Why is it down? Is the business broken? Has sentiment broken? There's a big difference between those two questions. When Meta fell to $88 in 2022, it was an ongoing 52-week low, week in and week out. The headlines were brutal. The narrative was toxic, but revenue was still growing. Cash flow was still massive. 3 billion people were still using the products every single month. I was fortunate enough to buy on the way down, and I got lucky to buy it actually on November 4th as well. Pure luck. Guys, the mistake I made was it ran back up to 200 too quickly, and I sold around there. Because that run up, I said, it'll pull back. No. Many of our community members are still holding today. They're up 6 or 7 times. That's a great place to start, though. 52-week lows. Take a look at them. We have them in our software. Right here, guys. 52-week low list. Or you can go to the near 52-week low list. Either one, it's a great place to start. Netflix is right there. Salesforce, Intuit. Guys, these are beautiful companies. These are beautiful companies. S&P Global, Adobe, Marsh, insurance business. I'm only looking at the first page and I'm like, oh my God, there's a lot of opportunity here. Again, it's about learning price versus value. Now, second, we use our stock analyzer tool. So let me pull up a Netflix, pull up stock analyzer. This is the most used tool by members of our software. Over 1 million times per year it's used. Not just that, guys, but I promise you that I use this tool every single day. Here's what we do. We sit down and ask questions. What do we think this company is going to grow revenue at for the next 1 to 20 years? You get to pick here how long you want to analyze for. What are the realistic profit margins? What do I think the proper PE for this business should be at the end of my analysis? Then we run multiple scenarios, low, middle, and high. Because guys, the future is unknown and we're going to make mistakes. But if we can make this range of ideas of what the company can do, we're going to get a range of prices. That'll give us a range of values for the business, and we compare it to today's price. Now, guys, I'm going to pull up my history on Netflix to show what I've done in the past. These assumptions I've made. I've made these assumptions. 7, 9, 11% revenue growth. Profit margin, growing here. PE, 20, 23, and 26, and my 9% intrinsic value return. And guys, the best part is, I have videos right here that'll explain every single one of them for you to explain how to look at it, how to make decent assumptions. We want to make sure that you have as many tools as possible for you to succeed. Once I hit the analyze button, it gives me my assumptions below. Yes, Netflix is selling near 52-week low. $76 a share, but guys, my low price is around 50, my high price is 100, 105. So it seems to be pretty close to value based on my assumptions above. Now, that's just a one-off. It's not to make or break my investment decision there. Then I need to go do more research. That's when I lean into the community. I have the community chat here, guys. We sit here, we have conversations in the general chat. People are chatting all the time about the things to do, the things to talk about. Investing alone is so difficult, guys. Our community consistently shares earnings breakdowns, valuation updates. They share their stock analyzer tools, risks that people might be missing. They talk about stocks hitting their price targets. It's all about strength of your process. When you have a group of like-minded individuals to talk with, when we experience times like this, the past few weeks, where tech is correcting, it gets a lot easier to ignore the noise when you have people around you. And here's what's the most powerful. When you combine 52-week lows, a strong community, stock analyzer tool, and that's just scratching the surface, guys. We also have screeners and community members' intrinsic value ratings. When you put all those together, you start seeing opportunities everywhere. Now, doesn't mean you should buy everything. Pick your opportunities and the ones you understand the best that are selling for a good discount. Even in volatile markets, especially in volatile markets, actually. Opportunity isn't just something that shows up when the market is calm. You need the volatility. I want you to embrace that. There's always opportunity hiding somewhere. Now, I want to make sure I've emphasized something very, very clear. The difference in the importance of price versus value. So many people say that they're long-term investors, but they don't actually know what they own. They know the story. They know the headline. They know what CNBC said, but they don't know the value. And when you don't know value, price controls you. If the stock drops 20%, you panic. If it drops 40%, you assume you're wrong. If it drops 60%, you sell. Why? Because you never knew what it was worth in the first place. For those of you out there who own a home, for those of you out there who own a car, anything of value, if the price temporarily fell in half tomorrow, what would you do? Would you sit there and bail on it? No, you'd probably sit there and say, listen, I know what this thing is worth. It's just something crazy is happening. Principle-driven investing, which I'm going to explain a little bit more soon, is built on one core truth. Price is what you pay, value is what you get. These things are oftentimes, most times, different. The stock market is a voting machine in the short run. It is a weighing machine in the long run. Famous words from one of the best investors of all time. Another way I phrase it, in the short run, what's popular is going to win, and what's not popular is going to lose. In the long run, cash flow and fundamentals win. That's what Stock Analyzer tool does for you. I showed you that tool. This is the purpose behind it, helping you understand how the two contrast. Now, let's cover the 5 core tenets of my principle-driven investing. I have these posted all over the place to remind myself daily how important they are in my entire process. And guys, I guarantee you it has changed the way in which I think, and I love it. It has changed me like in my core, not by reading it one time. All these things that I do here are simple because I want to repeat them over and over. I know that Bill Ackman, that famed investor, does a similar thing with what he calls his investing commandments. But mine are, first off, we are investors, not speculators. Second, every investment is the present value of all the future cash flow it'll receive. Third, if you don't understand it, don't buy it. Fourth, the market is a voting machine in the short run, and in the long run, it is a weighing machine. The fifth and most important one, a great story becomes a bad investment if you pay the wrong price. That's it. Simple, straightforward. Don't let people throw complex words at you trying to sound smart in the world of investing. You'll never hear the best like Buffett or Munger do that. Same goes for Peter Lynch. Keeping it simple is part of what made them what they are today. Now, guys, that principle-driven investing, I want you to have it. We made an absolutely free cheat sheet with all the principles and explanations of them. Click the link below. In a matter of minutes, we will email you. We'll give you access to that PDF. Keep it near you. As you read it every single day, as you get more emotional about investing, continue to read it. Now, guys, the best part about principle-driven investing is it's just a starting point. Every investor, every value investor develops their own process in unique ways. But I can guarantee you, they always come back to something similar to these 5 main themes. But from there, we have community members who build things like charts and options into their strategies to enhance returns and guide their decisions. We have investors who take these principles and our tools and apply it to different kind of companies, commodities businesses, energy businesses. Think Exxon or Mobil or Chevron. On the other hand, we have some who like to look for very profitable, high-growth businesses that are a little bit larger like Meta and Google. Others even build their portfolio with turnaround plays like Southwest and Disney coming out of COVID, or Intel before the recent jump. And guys, there's proof right there that in the short run, stocks are a voting machine. Intel is up 150% in the last year, while Nvidia is only up 40%. Which one's the better business? Clearly, NVIDIA is. Now, the important point is that each investor is unique, but we all have the same core foundation, a disciplined, value-oriented process. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. So guys, here's what nobody tells you about that 2026 stock market. It's not that volatility is coming. It's that volatility is normal and should be embraced. It's not that tech stocks falling means the system is broken. It's that markets move in cycles, and cycles always feel scarier when you're inside them. The people who struggle over the next few years won't be the ones who pick the wrong stock. It'll be the ones who let emotions control their decisions in the short run. The ones who sell when the fear spikes, then they wait too long to get back in. Maybe they even try to time a bottom that doesn't exist. Or they just stop investing because headline got loud. But who will win? They'll be the people who did the boring things. I guarantee you this. They'll be the ones who stay invested despite everyone telling them to sell. Dollar cost average and low ETFs, buy great businesses when they're below value, and guess what? They'll probably go even lower than when you buy them. But that's how real outperformance begins. Stick to a repeatable process because anyone can pick one great investment. But a process is what builds your wealth over decades. And finally, take your emotion, detach it from that short-term price moves. It's very difficult. Guys, you don't need to predict 2026 or any year in the future. You don't need to guess what the Fed does next. You don't need to know whether AI spending accelerates or slows. You need discipline. You need a framework. You need to understand what you're buying and what it's worth. And you need to be able to compare the price of what the market's telling you versus what you think it's worth. If the price is below that, you're probably going to buy. If it's above that, you're probably not going to. That's the entire reason why Everything Money was built. I wanted to teach people how to fish. Guys, my goals are different than your goals. We have people in the community that range from flat broke to worth 10, 20, $30 million. But they all go there for the same things, to learn. It doesn't matter what your wealth is. Learning about investing is very important. And the way in which successful investors think, they apply it to whatever net worth they have. The market will always overreact. That is a guarantee. And when it does, that's when portfolios are built. So if you want to go deeper into our 5 tenets of principle-driven investing and see how we analyze stocks step by step, not guessing, not speculating, I want you to check out the full course that's linked below. So here's my final takeaway for you. Control what you can control. Don't waste your time on what you can't control and let the process do the heavy lifting. So guys, if you enjoyed the video and want to see me walk you through the exact detailed process to analyze a stock using our software, I've literally put together an entire course with real examples just for you. So guys, click the link on the video above because I'm quite confident if you made it this far in the video, you're going to find that next one incredibly valuable. Thank you for your time.